We have the Fed minutes coming up. We've seen an aggressive rate hiking cycle. We have recession concerns. We have a lot of things going on that are pretty much unprecedented, not even to mention the economy coming out of the recession, the pandemic still. Are there something in the technicals that we have here that can cut through all that noise and disruption and give us a clear picture for the second half of the year?
Well, I think the thing to keep in mind is just so much negativity has been priced into stocks, and really things turned around when we got to late last year, on September, October, when it became evident we weren't moving into a stagflationary crisis or a major recession. And since then, we've seen a steady upturn in earnings revisions as it's become clear that too much negativity had been priced in as far as the outlook for earnings. And so I think what we're seeing is what often happens. Markets climb a wall of worry, and we're still at that point where we just now started to see flows coming back into the stock market. And we haven't had flows. In fact, we've had net outflows all year, even though the market's been working its way higher this year.
Yeah, great point. We were just citing some Bank of America data about inflows into stocks and ETFs. But I do have to ask you, I want to be very pointed about this. What technicals are you seeing that are giving you second half confidence? Because it feels like there's a lot of mixed signals.
Well, you can just start with something very simple, which is the 50-day moving average on the S&P 500, which has crossed above its 200-day moving average, and both of those are rising. That's something we saw back in 2020. In fact, we have a number of technical indicators that have given us signals that we hadn't seen since the second half of 2020, which was the beginning of really the run-up we had until the end of 2021. So, I think broad-based our indicators, we have a global balanced account model that's now reached its highest level in terms of equity allocation in several years.
Okay.
And so we're just getting more and more confirmation that this is a sustainable uptrend and not a temporary move higher.
Yeah, speaking of an uptrend, I just want to point out to the viewers, right now we're looking at the 50-day and the 200-day charts when it comes to the NASDAQ and S&P, and we're seeing the line there showing the 50-day is moving above the 200-day. For the viewers, the white line is the 50-day. So we talked about inflows into stocks. I know you're also looking at inflows into stocks and bonds. What signals are you seeing there that are giving you confidence in the second half?
Well, it's the fact that the flows are going. I mean, usually when you have, even if bonds are holding their own, stocks are going to outperform bonds on the upside. And we're seeing that trend start to turn since we've had those outflows, and now we're seeing more flows into stocks relative to bonds. And what's happening now is you've got sort of this inverted yield curve situation where you don't want to, you want to shorten duration. So bonds are, really challenged now because the whole case for bonds had been we're moving into a much worse economic environment, and that's becoming less and less evident. So that's going to be a headwind for bonds at this point. Bond yields have been in the trading range now for, several months.
All right, so historical averages have the S&P rising about 4% in the second half of the year after it increased 14% in the first half. That will put us at about 4670 or so. We haven't seen those levels since January of 2022. Do you believe we can get there, maybe even surpass?
Yeah, I think it's likely we'll be seeing record highs this year. I wouldn't rule out weakness during that seasonal period of August, September, October. That tends to be the worst period of the year. But, on average, a cyclical bull market, and we've been calling this a secular bull market since 2009, those bull markets take the market up by 100%. And, it seems like a stretch from here, but that's what the averages are, and everything's lining up to say this uptrend's still intact. So
it does seem like a stretch. Do you have an S&P target for year end, just to give us a sense of how bullish you really are?
No, I don't personally have an S&P target. I look at things globally as well because we track the MSCI indices, and the All Country World Index is the major benchmark I look at. And the U.S. is sort of leading the way here, led by technology. The U.S. has been outperforming, and we're overweight the U.S. within a global context. So, I think we'll be likely seeing a year. Our entering the year, we had a conservative estimate of 10% for the year, and I think we're already we're going to be above that by the time the year is over.